I have received quite a lot of questions regarding the IFBs 1 2022-14 and 2023-17, which have already been issued by the central bank on behalf of the government in pursuit of collecting 70 billion through domestic borrowing. I've decided to do a video that will answer at least 5 types of questions across the many that I've received. And to begin with, the first important thing that we need to understand is what a bond is. When the government or a company intends to source finances from the public, they issue a document that acknowledges that transfer or exchange in money for a loan. That document is what we call a bond. Today, with advancement in technology, we no longer receive hard copies of these documents, and therefore it suffices to refer these documents today as electronic bonds. And therefore, what a bond will be defined as today would be an electronic paper appreciating a loan from a member of the public to the government or a company. This document becomes a full contract upon satisfying 3 important components under the law of contracts. There is an offer, which is the bid that you place, and a bid now becomes an expression of interest by you, the lender or the purchaser of the bond. You are expressing an interest to the government in extending a specified amount of money, that is the face value that you indicate upon bidding, as a loan to the government and on the terms and conditions of the electronic bond. And the second thing that is very important that need to be satisfied in this case is the acceptance of your bid. So once your expression of interest in form of a bid is received by the central bank, which is the agent of the government, they reserve the right to accept or reject your bid. Once that bid is accepted and communicated back to you, then that is a satisfaction of the second element that needs to be satisfied in this legal contract of lending or borrowing. And the third element to be satisfied is when you pay, you RTGS payment for that bid that is accepted. And the amount that you pay, that is what legally we call a consideration. So once you have settled a payment for your successful bid, you will have tendered consideration for that contract to have satisfied the 3 elements. So upon payment for your successful bid, then the contract of borrowing or lending to the government is fully established. In my introduction, I've talked about a bond with relation to the government and also corporate bodies or companies. Therefore, bonds are electronic instruments or electronic papers appreciating loans. If this loan is to a government, that is what we call treasury bonds, treasury bills, depending on their duration or maturity periods. What goes to companies is what we call commercial papers or corporate bonds, depending also on their maturity period. If the horizon is short, denoting a period of up to 1 year for repayment, then for government, that becomes a treasury bills. For companies, that is a commercial paper. Therefore, at any given point, you hear me talk of a commercial paper as an equivalent of a treasury bill, is only that the receiver of those loans are different, but the instruments are more or less the same in terms of the horizon. Then on the side of the treasury bonds, those are long-term loans to the government, while commercial or corporate bonds, that is a long-term loan to a corporate body or a company. Then now we narrow down to these 2 bonds that we have here. For treasury bonds, we have 2 main types. We have the FXD, of the fixed coupon bonds, and we have the infrastructure bonds. The FXDs, we abbreviate them as FXD, and the infrastructure bonds, we abbreviate them as IFB. In those two categories, we further divide them into two depending on their issue. We have original issue and we have reopened issues. When a bond is issued for the first time, we have the prefix FXD. If it is reopened in future, then it acquires an extension of that abbreviation to add a numeral 1. Thus, it reads FXD1 or IFB1, and the 1 indicates it's a reopened instrument. Then what does that mean? It only means that a reopened instrument, you are able to get it from two places. You can access it from the Nairobi Stock Exchange, which is the trading market. All instruments, once the auction closes in the primary market, which is in this case the CBK issue auctions, then all those instruments are pushed to the secondary market for purposes of trading, exchanging instruments between new buyers and the old buyers in the primary market. Once an instrument is reopened, it means it is still existing in the secondary market, and now it has been reintroduced again through the primary market. So for these IFB1 2022-14 and IFB1 2023-17, these instruments, you can access them from the secondary market and in the primary market. And that gives you a good grounding to determining the price. You can check the price at which these instruments are trading in the secondary market. And because in the primary market, the government is competing for financing with what is exchanging in the secondary market, then the price at which these instruments are trading in the secondary market will also be part of your determination of what would be the possible dirty price for these instruments in the primary market. That I've given an idea in determining what will be the possible prices for this instrument. But because of that aspect of the government will be competing to get the same financing from the same public who can access that instrument from the secondary market, then in order to have an advantage, then the central bank will make sure that they give a price, a dirty price that is lower than what is trading in the secondary market. That said, then we now need to narrow down to what are the numbers looking like and more when it comes to investment of up to $1 million in these two infrastructure bonds. And I have several things that are very important after my analysis, and I'm very sure you would be interested in knowing those figures. Let's look at those figures after 3 seconds short break. In the meantime, give a like to this video, engage in the comment section, and don't forget to share this video to another person. See you after 3 seconds short break. Welcome back to our continuation of the IFB1 2022-14 and IFB1 2023-17. The first question that I've received relates to the difference between these two instruments. And to analyze the difference, to establish the main difference, we have to look at several things that are important before the eyes of many retail investors. And the first one is the coupon rates. The IFB1 2022-14 is at a coupon of 13.9380, and the IFB1 2023-17 has an IFB as a coupon rate of 14.3990. If you look at those two coupon rates and establish their difference, you are getting a value of 0.4610. That is closely, if you round that off to the one decimal place, is about 0.5%. That is not material enough to be an established difference between these two infrastructure bonds. And in essence, where two instruments or bonds are issued with varying maturity periods, in this case we have one at 14 years and the second one is 17 years of maturity. The difference of 3 years in their maturity period is the one that occasions such a small difference in their coupon rates. So the 0.5 is to compensate for the extended maturity period for the second IFB of a 17-year horizon. So that does not establish a good difference between these two bonds. The other establishment on a difference will be on the specific actual maturity period for a retail investor intending to invest an amount up to 1 million. And this one we buy from the redemption structure. This piece or part of the prospectus establishes that these bonds will be redeemed in two parts or portions. Those two portions establish the redemption structure where 50% of the IFB 1 2022-14 shall be redeemed in November 2030. That means that investing up to 1 million in this particular bond, then you are investing in an actual investment period of 5 years and 2 months. For the second bond of 17 years horizon, if you're investing an amount of up to 1 million, because the redemption structure establishes that 50% of the investments will be redeemed by February 2033. That by interpretation means that you will have invested in an actual maturity period of about 8 years. And that is because, and the extension of this redemption structure states that any investment of up to 1 million per CSD account shall be redeemed in full on amortization. That refers to the first amortization. So the 50% that applies to amounts beyond 1 million for the two bonds, it means that all investments of up to 1 million will be redeemed in full on first amortization. That means 1 million in the IFB 1 2022-14 will be redeemed 100% in full 2030 November. And 1 million invested in the IFB 1 2023-17 will be redeemed in full by February 2033. The minimum amount allowed for investment in these two infrastructure bonds is 50,000 Kenya shillings. So from 50,000 to 1 million, that is the investment horizon of 5 years and 8 years in the two infrastructure bonds. So again, that actual difference that we established as an extension in the second infrastructure bond does not really come out as the main difference for these particular two bonds. Then the third item to look for when you are looking at to differentiate the two bonds are the coupon payment months. And these are very critical for those who are looking for laddering instruments, those who want to establish periodic fixed returns or incomes. The first bond, the IFB 1 2022-14, will be paying its coupons in May and November. The second bond, IFB 1 2023-17, will be paying its coupons in March and September. That forms a major difference between these two bonds because the payment periods or the maturity periods haven't. The coupon rates also haven't because of the marginal 0.5% between the two coupon rates. But when you look at the coupon payment months, this is where the major difference between those two instruments is. And this is so important that a retail investor or any investor looking to establish for periodic fixed returns will consider the two bonds as I will highlight. And also, if you were to spread these 4 coupon payment months, assuming we are investing in the two bonds, it establishes a very good structure that pays you coupons after every 3 months, averagely. So investing in these two bonds, you are getting fixed coupons after every 3 months. The first one March, We have another one coming in May, another one comes in September, and the last one coming in November. You will have established a ladder that pays you coupons after every 3 months. And that is very important to establish as the key difference between these two bonds. And it will be a very important for those who want to invest, particularly to establish laddering structures. And if we take a good example, if one was to invest an amount of 20 million in one of these bonds, because the bonds averagely they are giving us a coupon rate of 14%, 13.9 and 14.3 rounded off will give you a 14%. 14%, these being infrastructure bonds which are tax free, that means the 14%, this is our net return. So this person who invests 20 million in either of the two bonds, they are supposed to be getting a total of 2.8 million as the total coupons. If you divide that amount into two, because bonds pay their coupons yearly or 2 times in a year, it means that this individual will be getting 1.4 million after every 6 months. Assume this same person investor spreads this amount equally between the two bonds, investing 10 million in the first bond and 10 million in the second bond. It will translate to a total of 2.8 million coupons in 1 year. But now, because these coupons are paying in different months, we have biannual payments for each bond. So giving us a staggered payment 4 times in a year, once every 3 months. Because we are getting the March one, you go to May, September, and November. And so one bond invested an amount of 10 million, giving us a 1.4 million in a year, means that every payment will be receiving a total of 700,000 per quarter. So instead of getting the 20 million in one bond to receive 1.4 million yearly, you spread the amount in the two bonds and receive 700,000 every quarter. A suitable laddering process that can be used as an education plan at a university level. Universities now doing their 3 semesters and would like that can be used. You assign an objective or a goal in every structure that you assume for investments. And now, because we had planned for $1 million in the worth of investment in the bonds, we can now use the same structure and apply it for any amount of investment. Somebody who intends to invest $1 million but breaks down to invest 500,000 in one bond and 500,000 in the other bond. What that would translate to is that $1 million should be able to give us a total of 140,000. So 140,000 will be enough to give you an amount of 35,000 every quarter. And the same can be applied for whatever amount being invested. But such spread is what gives you diversification of investments. And as a matter of principle, we say that do not over diversify. So smaller amounts of investments should not be broken into two. As low as 100,000, 50,000, 150,000, those ones can be invested in one bond. But as you progress in the total amount that is being invested and looking at the goals or objectives that you have for that structuring, then you can choose to apply the two bonds for a huge amount of investments. So $1 million can give you 35,000 every quarter. 10 million can give you a coupon of 350,000 every other quarter. We'll continue with the other elements on taxation and pricing after 3 seconds, a short break. So don't go away. Welcome back. And having considered those differences, and we have established a very important structure, let's now look at the taxation. The question of taxation, infrastructure bonds being free of taxes, then it forms another very important ground on the basis of analyzing on whether you can obtain some amounts that you have invested in variable investment vehicles to the infrastructure bonds for investing. And that is what gives you a fixed baseline. Every individual has a specific financial baseline. That baseline can be anchored on fixed income or fixed income generating investment vehicles. And in this case, I want us to compare the current returns that we are getting from the collective investment vehicles. Those are the fixed income funds, we have the money markets, we have the bond funds, and we now compare with what we shall be getting from these infrastructure bonds. And if I take a good example of what is common among many people, and that is the money market fund, the highest paying money market fund today is giving us a gross return of between 16% and 15%, or in that region. And that big gross return, it means we are supposed to be considering a deduction of a withholding tax of 15%. For your information, infrastructure bonds being tax-free, we have the fixed income bonds being taxed at 10%, we have the treasury bills taxed at 15%, and those collective investment vehicles, except the special ones being taxed at 15%. And therefore, here we are looking at an investment vehicle returning between 15 and 16% gross, meaning that the net shall be between 13.5 to 12.75%. Comparing that with the 14% that you are getting from the infrastructure bonds, a margin in the region of 2% is good for consideration on the foundation that the infrastructure bond coupons will remain fixed throughout the investment period. And the returns in the money market fund or the collective investment schemes are varying. And at this time, when we are experiencing a decline in the market interest rates by the treasury bills, to which the money market funds respond to, meaning that the money market funds returns will still be coming down, and as normal, the declining trend starts with a steep decline, then plateaus at some point, then continues with a decline before they settle. And we are at a point, if you look at the rates between last year, October, September, to what we are having today, you can consider that one clearly as a plateau because the change hasn't been much. The market interest rates has almost stabilized at about 11%. And looking at that 11%, comparing with the coupons of these bonds, that automatically tells you that there's a possibility that these bonds obviously will be coming at a premium. And that is for the purpose of a willing investor to keep an extra amount to cater for what shall be required for the amount above 100 shillings or the par value. And again, infrastructure bonds are not very common. Our tradition has been that we get an infrastructure bonds issued on a yearly basis. Having these ones in the first quarter, our hopes is that we may get another infrastructure bond issue later in the year, or we wait until 2016. Then the most important aspect in comparing those the collective investment vehicles and the infrastructure bond investing, the main difference will come on the question of compounding. The amounts you are moving them from an auto-compounding investment vehicle to a non-compounding investment vehicle. That means that the auto-compounding investment vehicle relieves you from the compounding question. But in this case of bond investment, once you receive the coupons, you are the one who is supposed to reroute them into another investment for them to compound. And that is what now brings out the major difference when you look at the total analysis and what you are getting from the varying investment vehicle. So the advice is what you will have invested in these infrastructure bonds, then once the coupons come back, reroute or reinvest those coupons in another investment vehicle. Could be another bond, could be back, take them, the coupons back to the money market fund or the fixed income fund or whichever source you had obtained, so long as that return is compounding. Compounding is when your returns also get reinvested to regenerate other returns. That is very important. For compounding purpose, you are getting your coupons into other investment vehicles. And just as a reminder, for purpose of compounding, we have a flagging button in your DAO-ZSD account that you can turn on as a prompt that in future when other bonds are on issue, the fact flagging is an auto that deducts the total amount that are supposed to be paid back to you for you to top up the difference for a future investment in the bond market. Then with that, we look at the pricing model. The price at which we pay for these bonds, we call it a dirty price. And a dirty price consists of the par price or the premium price, which we call the clean price, which is determined by the auction. Then to it, we add the accrued interest to get the actual figure that we are supposed to pay. These bonds, reopened bonds, means that there are investors who have already invested in these two instruments as they are trading in the secondary market. And as new investors, we are supposed to be maintained at par with the current investors. And for that reason, the coupon that has accrued from the last immediate payment up to the value date of this current issue, that interest is what we call the accrued interest. And it is loaded to the clean price to determine the amount that you will be going to pay for the purchase of this particular bond, which we are calling the dirty price. And that accrued interest that you will have paid will be paid in the next coupon payment date when the current investors are also being paid. And if we take a good example of the second bond, the IFB1 2023-17, which is paying its coupons in March and September, the value date for this particular issue will be on 17th February of 2025. And that is the date that we consider in determining the accrued interest. Then the next coupon payment date will be in March 2025. So that investor will invest in this and the accrued interest by February 17th. Then in March, they will get back that coupon when the other investors will be paid. That answers the third question that I've received, and I found it very important is, shall we be paid the coupons in March if we pay this accrual or we invest in this bond in February? Yes, the coupons in March will be paid to all the investors, including us, the new investors into this current investment, because we will have paid, including the accrued interest in that particular bond. And that is now what gives us the two types of transactions when you are purchasing these types of instrument from the stock market. There is a price that we call X interest price and another one that we call CAM interest price. CAM is means, in other words, means together with or in addition. So CAM interest price is the price that also gives you a right to receive the next interest payment. And that is the price that includes the accrued interest. So we are purchasing this bond CAM interest price, and that is the reason we have to receive the next coupons. Then lastly but not the least, we will look at the important dates that relate to this investment, and we have the selling period. That is the period within which you are allowed to place your bid, and that stems from 23rd of January 2025 all the way up to 12th February 2025. Within that time, you can assemble your investment, create your DAO ZSD account, get it approved, make arrangements for the amounts that you intend to invest, because the payment period is always shorter, goes for about 4 days, while the bidding period we are given a whopping 20 days. Then on 12th February 2025, which is the closing date for bidding, and that is the reason why your bids are supposed to be placed anytime before 10 o'clock of that day, because in the afternoon, that is when the auction takes place. And therefore, the bid closure date of 12th February 2025 also doubles as the auction date and the result date. The auction is the one that gives us the results. So traditionally, before we have been getting the results, the payment details, on the Friday, because auctions take place on a Wednesday, results come out the same day, but we used to be receiving the payment details on Friday. But because of the advantages of technology advancement, then once the results are out on the auction date, that is 12th of February 2025, the results and the payment details get disbursed, and you are able to access those payment details from your transaction tab in the DAO ZSD account, and in many cases is also forwarded to you via an email or an SMS through the line that you programmed when you were creating your DAO ZSD account. Then we have 13th February 2025 all the way to 17th February 2025. That is the payment period. Once you have received your results, your payment details, within that period up to 17th, which must always be on a Monday, the settlement date, which is the value date, is always on a Monday. You are required to make sure you have made your payment for your successful bids during that time. Then the same settlement date or the value date, that is when your DAO CSD account will be updated with the details of your purchases and the values in your portfolio investment. The same day the value, the settlement date, again, the instruments will be transferred to the secondary market for purposes of trading. And that sums up everything that you need to know about infrastructure bonds, the ones that are an issue this period, and the future infrastructure bonds. Thank you for watching, and see you in the next video.